Can you imagine if you were to learn today that your financial advisor is going to get more money from your qualified retirement plan than your children? Put another way, how about if we learn that you're setting yourself up to give 25% of your retirement income away to your advisor? Do I have your attention yet? Advisor fees are our topic today. You're in the right place. Let's get started. I'm Mark Tomei, and I'm the founder of Hindsight Financial. For the best conversation about confusing money traps that confiscate your retirement dollars, subscribe to the YouTube channel and don't forget to click the notifications bell to be notified when we roll out new videos. I think this is a great time to start talking about this because all across our industry we are starting to see a push towards a fee-based model. And that's where you pay your advisor with a percentage of your account value. And the idea behind this thinking is it aligns the goals of the advisor to the goals of the consumer. And a typical way to frame the conversation is to say the better you do, the better we do. I'm going to ask who this works better for, and we're going to dive a little deeper into this as we go along. So because managing a complicated portfolio to drive retirement income safely and reliably is not for the faint of heart, typically people will hire an advisor to help them go through this process. So when we talk about advisory fees, I'm referring actually to recurring fees that are tied to your asset level. And that can come in the form of charge on your retirement account, or it could be an annual planning fee that's based on assets under management with the firm. But either way, it's those recurring charges that are tied to your account balance that's the focus of our conversation today. So we hire advisors. Typical fee arrangement, you'll see on the screen here, but what we've seen is there's fees all over depending on the size and complexity of your portfolio, but generally somewhere between 0.25% all the way up to 3.5% we've seen. Could be the fee-based model that you're using. When you see the fee arrangement, there's a few variables to be aware of. Number one is the frequency of the premium. So you can see on this particular the fees are paid at the end of each quarter based on the ending account balance. That's not the case in every way, so I just want you to be aware that those charges could come out daily, they could come out monthly, they could come out quarterly, they could come out annually. And then the next thing to understand is, what do they base the fee upon? Is it the average account balance, the average daily balance? Is it an ending balance? Is it a beginning balance? It's important that we understand what are we paying for, and is it working for us, driving the results that we're looking for? So this is a typical fee arrangement. And when you save your whole life and you're trying to build a nest egg that is going to one day take care of you, how you pay for that service and that advice makes a very big difference. In our example here, just going to use a simple 401k. $1 million 401k could be an IRA. But what I want you to understand here is traditional thinking says we build our account balances up to their peak levels, hopefully by the time we retire. And then we're going to live off of the account balance in retirement. One thing to understand here is when you have that type of account, we should always understand it's not all ours. So your IRA, your 401k, any qualified retirement plan, you're looking at the statement and you see the account balance, remind yourself, that is not all my money. Some of this money, and hopefully not too much, but some of this money is earmarked to go to the Internal Revenue Service in the form of taxes. So there's a portion of your account that is yours to spend. There is a portion of your account that will be the government's to spend. And the problem is we never know exactly how much that is. Unless we spend our portfolio out in 1 year, we're never really going to know. But in our case here, we're going to assume a 25% tax bracket. And on a $1 million portfolio with a 1% fee, the fee would be a $10,000 fee, and that's charged against the gross account value to include the money that is going to eventually go to the IRS. So this was a big aha moment for me the first time somebody explained it to me this way. I'm actually paying an advisor to manage money that will never land in my pocket. Does that make you mad? It kind of makes me mad, and I'm not you. But just a side note, when you do take the money out to pay the fee, in the case of the IRA or the 401k, in this case, the fee would generate a $2,500 tax bill. So then the question becomes, where do you go to get the money to pay the $2,500 tax bill? Back to the IRA. And we call this circling the drain. Every new withdrawal to pay a tax or a fee generates a new tax and a new fee. So when we get to retirement, keep in mind, all of our lives we've been watching our account balances grow and maybe not paying much attention to fees. But when we get to retirement, the advisors and the retirees challenge is to take this portfolio of disparate assets, types, kinds, and how do we build that to drive consistent, reliable income like the kind we get used to in our working years in retirement. So the fee is taken off of the gross amount each year. We have our total portfolio. The advisory fee is charged on the gross amount or the total. From there, we also have a 4% rule or limitation. I've talked about this a little bit more on a previous video, but for now, just assume we're only supposed to safely take about 4% of our portfolio each year so that we don't run out of money before we run out of time. So the advisor gets 1% of the gross, and we get 4% of the gross each year in retirement. And then taxes are taken out of our share. So we get to keep what's left over after the advisors had their fee, the government's taken their taxes, all other fees are paid. In some cases, you can be 5th or 6th in line to get your money when you retire, just depending on where you live and how your money is positioned. But this is the big picture for retirement. The fees come off the top. There's a constraint on how much we can spend. So when you look at the math of how it all plays together, if I have my $1 million IRA, some portion belongs to the IRS, some portion belongs to me, a 1% fee. In retirement, I take out my safe withdrawal of 4%. That's a $40,000 gross withdrawal. My advisor gets 1%, if we want to assume that's an average fee. Typically, they're in the 1.5 range, but 1 makes for easy math. So a 1% advisory fee coming out of my total is $10,000. So my advisor's share of my gross income in retirement would actually be 25%. That's before taxes. After taxes, it even gets worse. Did you know it worked that way? Because I really never thought of it that way, and truthfully, I was a consumer who has paid these fees, and I've also been an advisor who has charged these fees. I have reversed that, and I'm here to share a better message with you. When we look at the 4% withdrawal rate in retirement, pay close attention to our chances of success. So withdrawal rates on the left, portfolios across the top, chance of success in the middle. Pay special attention to 4% on 75% bonds, 25% stocks, a typical aggressive retiree portfolio. At a 4% withdrawal rate, we have an 87% chance of success. Now, I've already shared with you, in that realm, if I have a 4% withdrawal and I pay my advisor, then my advisor gets 25% of everything that I get in retirement. If I increase my withdrawal, so in other words, I keep 4 for myself, but I increase my withdrawal by 1% to pay the advisor, take a look at what happens to the success rate of my retirement portfolio. Success is defined as having $1 or more after 30 years of withdrawal. My success rate drops from an 87% to a 42% just because I took that extra 1% to pay my advisor. Surprise, surprise. Did you know it worked that way? Well, if this video was interesting for you and you want to learn a little bit more about confusing money traps and how they confiscate your money, you have to think, we pay these fees because we hired the advisor. We hired the advisor because we complicated our money. Has anybody ever asked, did we really need to complicate our money in the first place? For the answer to that question and many more, check out my webinar, The Six-Figure Retiree Primer with Money Hacks for the New Economy at sixfigureretiree.com. Thank you a lot for the time today. If this was interesting, don't forget, subscribe to our YouTube channel and click that notification bell. You'll be notified when we roll out new content. Thanks. Have a great day.